In today's lesson, we want to look at another pertinent international financial reporting standard. This particular accounting standard is also pertinent because you may have a full question on it, or it may also form part of the additional information when you're preparing the income statement for a single entity, or when you're preparing the financial statement for a group or consolidation. So this particular standard is also important when it comes to examination, and as well as when you're applying it at your workplace to account for an item of asset. At any point in time, the value of an asset, that is the book value or the carried amount of an asset, must be equal or must be the same as its recoverable amount or the fair value of that particular asset. So what it means is that at any time when at the end of the reporting period, the entities carried amount or the net book value must be equal to the amount that, if it wants to be sold today, this carried amount must be equal to this amount. Anytime there's a difference between the carried amount and the recoverable amount, then this raises an issue or a concern to the management to perform an activity. There is no issue if the recoverable amount is greater than the carried amount. That means the entity can make some disposal gain when they are disposing of the asset. But there's an issue if the carried amount is greater. So the carried amount is greater than the recoverable amount. In other words, the recoverable amount is lesser than the carried amount. If the recoverable amount or the amount that we are going to get from the asset currently, if being disposed of, is lesser than its carried amount, then there is an issue. And this issue, according to the International Financial Standard, it is known as impairment loss. And its accounting treatment is prescribed in the International Accounting Standard 36, that is impairment loss. So in this lesson, we are going to look at how to account for it, the other important things or concepts you are supposed to know under the standard, like reverse of impairment, when the impairment is pertaining to a cash generating unit, and also when it is pertaining to an individual asset, and probably we will solve questions to augment our understanding. Right, so what is the meaning of impairment? When we say impairment, basically we are saying that an asset is said to be impaired if the carried amount, or in other words, the net book value of that particular asset is greater than its recoverable amount. So if the carried amount of an asset denoted here by CA is greater than its recoverable, this is recoverable amount, then we say there is an impairment. Now, what is the objective of IAS 36? The objective is to make sure that at any point in time, the carried amount of the asset must equal or must be the same as its recoverable amount. What is carried amount? We've already looked at the International Accounting Standard 16, PP, where we have looked at how to determine the carried amount. But for the purpose of revising or knowing what the carried amount is in this particular lesson, you see an asset carried amount is when you have taken away the accumulated depreciation, and then accumulated impairment loss from each original cost gives you the carried amount. So after lessing the accumulated depreciation and accumulated impairment from the cost of the asset, you get the carried amount. Now the recoverable amount is the higher. So that means you must have two values, and then the higher of these two values, any of them that is the highest, becomes the recoverable amount. And which values are we talking about in this case? We are looking at the fair value of the asset. So the fair, let me use initials. So the fair value less cost to sell cost to sell or cost to dispose. So you'll be given a fair value of the asset and the value in use. The value in use. Alright. So your recoverable amount is the higher of your fair value, less cost to sell or less cost to dispose, and your value in use. So if your fair value less cost to sell is $100 and then your value in use is $150, in this case your recoverable amount is going to be the highest. So it's going to be the $150. Now, what is fair value? We've already also looked at IFRS 13, where we looked at fair value measurement. So if you have the fair value and you have taken off the cost that it will you'll be incurred to sell the asset, then you say that is your fair value less cost to sell. Some books say this fair value less cost to sell is the same as net realizable value. The fair value less cost to sell is the same as net realizable value. Now, how do you determine your value in use? Probably you take a practical questions subsequently, and we will look at what is value in use. What we are looking at here is looking at the basic definitions of some of the terms we will be meeting in our discussion. So here, the value in use is basically the present value of the cash inflows of the assets. Remember, it's cash flow, so both cash inflows and outflows of the assets, including the scrap value of the item. So when you take the cash flows, so the cash flows, and then the scrap value or the salvage value or the disposal value, the residual value of the assets, and you discount all these values into their present terms or into their present value, we are saying that that is your value in use. So assuming that the cash flow is year 1, year 2, year 3, year 4, and then we have year to be $400, year to be $350, year 450, and the last year is maybe 300 plus the residual value of maybe 200. After discounting this using an appropriate discounting cost of capital or interest rate, which will be given to you in the question, after discounting them to their present value and sum them up to get your net present value, then that becomes your value in use. So that is basically how to determine your value in use. The fair value will be given to you when there is enough information in the market to determine the fair value. Now, another important concept or term we will be meeting in the lesson is what we call CGU. We call it cash generating unit. Cash generating unit. It is the smallest identifiable group of assets that generate revenue or cash inflows to the entity that are largely or that are independent of the cash inflows from other assets or other group of assets. So when we say cash generating unit, we are saying that it's a group of assets. These assets, their inflows or their revenue cannot be split or cannot be identified or cannot be attributed to a particular asset. This asset comes together to generate that inflows to the entity, and these inflows are independent of the inflows from other assets. Then we see they are cash generating unit. You will look at how to calculate for their impairment in case there is one, and then probably we will look at how to calculate for impairment of a single or individual asset as well. So this is basically the definition of some key terms we will be meeting in our discussion. Now, the scope of the standard say that the IAS 36 covers all assets. It covers all assets except inventories, which is accounted for under IAS 2. That is employee benefits. That is employee assets accounted for under IAS 19. We also have financial assets accounted for under IFRS 9. We also have the non-current assets held for sale. All those items does not fall within the scope of what IAS 36. We again have deferred tax, and then we also have investment property, which is measured using the fair value model. All these assets does not fall within the scope of IAS 36. Apart from this asset I've mentioned, any other asset covers or fall within the scope of what IAS 36. At the end of every reporting period, an entity is supposed to carry out an impairment review to see if any of its assets has an indication of impairment. What does it mean? If you want to undertake the process of identifying if an asset is impaired or not, we have some few steps the standard outline. The steps is that first, check if there is an indication of impairment. So if there is an indication of impairment, then continue to determine the carried amount and the recoverable amount of the asset, and then reduce, if there is actually an impairment, then reduce the asset carried amount to its recoverable amount. And then any difference between these two must be accounted for. That will be accounting for impairment will be accounted for in the P or L account. That is if the asset was not previously fair valued or revalued, and doubt there was a revaluation surplus or gain on it which was sent to the OCI. If there is one like that, there is the impairment loss have to be sent there. You will look at it, you will look at them, you will look at all these steps critically and see what goes into them, and then you now have to carry the amount of the asset as its recoverable amount. That's a step. Now, so the first thing is, at the end of every reporting period, as an entity, you are supposed to check for an indication of what? Of impairment. Now, this indication can be generated from some sources. Some sources can give you the indication that, oh, this particular asset has an indication of impairment. Then you can go ahead and determine its recoverable amount and its impairment, its recoverable amount and its carried amount, so that you can establish if actually you should review that particular asset for impairment or not. And these sources are categorized under IAS 36 under two headings. We have the internal and external sources of indication. So we have external and then internal. External and then internal. So first, let's look at the external. External, if the market value of the asset has declined, then there is an indication that that particular asset must be reviewed for what? For impairment. Again, if the interest rate has increased, you will probably use the interest rate in computing for the value in use. So if the interest rate of the particular asset has increased, then there should be an indication of what? Impairment loss. Again, if there is a changes in what? The technological, the market, the legal, and then economic environment which adversely affect the entity, then we say that there is an indication of what? Impairment. All these falls under the external sources of indication. Now with the internal, when the asset is damaged or it becomes obsolete, then there is an indication. When the entities have a plan to discontinue or to change how the asset is used, then also there is an indication of what? Impairment. Again, when the economic performance of the asset is worsened as compared to expected, then there is also an indication of impairment. And again, the last one is when the remaining useful life of the asset has changed or has reduced as compared to what has been suggested earlier, then we say that there is an issue of what? Impairment. But there are exceptions to these sources. There is three categories of assets that even when there is an indication or there is no indication, those three categories of assets must be held for an impairment review. And the first one is goodwill. So goodwill acquired through business combination. The second one is that an intangible asset that is having a definite useful life. And then the last one is that the intangible asset that is not available or that is not yet available for use, whether there is an indication of impairment or not, anytime an entity has these categories of asset, they must what at the end of the reporting period, they must what establish to see, or they must hold them for impairment review to see if any of these assets is impaired or is not impaired. So this is basically about the first part, how to identify if there is an indication of impairment or not. One thing you're supposed to remember is that anytime you review an asset and then there is no indication of impairment, then you do nothing because the asset is not impaired. So you do nothing, you don't proceed to the next step. But once you have established that there is an indication for impairment of an asset at the reporting period, then you have to go on to the next step to determine the carried amount of the asset and to determine its recoverable amount to see if actually there is an impairment. So if there is one, then you have to reduce the assets to the recoverable amount. So now let's look at how to determine the carried amount as well as the recoverable amount, and then from there we will look at the accounting treatment of impairment. Then we will look at other important issues like reverse of impairment and then impairment that is pertaining to cash generating units. So as established earlier, we said that the carried amount of an asset is the cost of the asset less its accumulated depreciation. And if there is any impairment loss, we also less the accumulated impairment loss. We established this earlier on. We also have a lesson on this already, so we're not going to spend much time over here. So at the day that there is an indication of impairment, the entity must determine its carried amount or its book value, and then from there must also determine its recoverable amount. As we established earlier on, is the higher of two things: the fair value less cost to sell, and then the value in use. The value in use is when you have find the present value of all the inflows and outflows pertaining to that particular asset, including the residual value of that particular asset. So any of them that is high becomes the recoverable amount. Under normal circumstances, they don't mostly give you those cash flows, and those cash flows for you to discount. They probably provide the value in use straight away for you under most exam situation. And then the value in use, they can give you the fair value and they will give you the cost to sell for you to determine your fair value, to compare these two values to see which of them is the highest. Now, anytime there is an impairment of which the carried amount is greater than the recoverable amount, the accounting treatment is that you find the difference between the carried amount and the recoverable amount. And that difference becomes the impairment loss. For instance, if you have an asset here having its carried amount to be $1,000, this is having 900 and this is having $850. So here we say there is an impairment because the recoverable amount of the asset will probably be the 900 because it's the higher of the 850 and the 900. So here the asset will now be recognized as its recoverable amount as what? 900. And in this case, the carried amount of the asset on that particular date will now become 900 instead of the $1,000. Now the difference of 100 will be sent to the P&L straight away. In fact, it will be debited as a means of what? A loss to the entity. So it will be treated as a loss in the P&L account. That will be the $100. Now this treatment is done if the asset was not previously having any revalue surplus or revaluation gain. If the asset was previously having a revaluation gain or revaluation surplus, that means the revaluation gain or revaluation surplus was previously entered in the other comprehensive income. It was credited. If there is one, then we have to first send the impairment loss to the OCI, and then if there is any excess of this impairment loss before it will go to the P&L account. Let's take a question to augment this simple illustration over here. So we were told that an entity property was revalued to 500,000 on 31st of March 2013. So it was revalued to an amount of 500,000. Remember that the question link will be at the video description, so you can click on the question link to get access to the full question. Now with the revaluation gain, so this revaluation gives us a gain of $200,000. So and it was recognized in the other, they've informed us that this particular gain was recorded in the other comprehensive income. And then we are told that at 31st December 31st March 2015, that is after 2 years of this revaluation, there was an impairment on the asset. So the asset is now carried. The carried amount of the asset as at this date is $460,000, and we were told that it was having the recoverable amount of the asset. It was given to us straight away as 200,000. So since the recoverable amount is lesser than the carried amount, there is an issue of impairment in there. Now the question is, what is the impairment and how should this be treated? So the important thing is that what is the impairment here and how should it be treated? Now, since we've known that the carried amount as at 2015 is 460,000 and then the recoverable amount is 200,000, then there is an impairment loss of about 260,000 over here. Now the issue is, how are we going to treat this? Previously there was a revaluation gain of 200,000 which was treated in the other comprehensive income as at 2013. So the treatment here is that we will send the 200,000 of the impairment loss to our OCI account. Remember that this is going to be a debit balance over there because it is an expense, so that it will complement or it will cancel the already revalued gain on the asset. We are doing this because the asset was previously revalued, which was the 200,000 in there. So there was a revalued surplus of 200,000 in there. So here the loss of 200,000 has to go to the OCI, and the remaining 60,000 of the impairment loss will go to the POL account as what? Impairment loss, which is the 60,000. So remember that if there is an impairment loss and already the asset was revalued, the treatment is that you send the impairment loss to the OCI, to the amount that the impairment loss or the revaluation surplus can cater for the impairment loss. The excess is then transferred to the POL account, and subsequently, remember that the carried amount of the asset will now be the $200,000. So this is how to go about such questions in case you meet them. All right. So before we look at the impairment that pertains to cash generating units, let's look at another important concept that the standard prescribe. Subsequently, these impairment indications or losses is something that is subjective in nature. It is based on the management judgment. So subsequently, after an asset has been impaired and reduced to its recoverable amount, there may be a favorable indications in the future subsequently, and therefore there may be a need for the impairment reversed. What does it mean? There may be sometimes that an asset has shown that there is an indication for impairment. Probably the asset was impaired. That means the asset was reduced from its carried amount to its recoverable amount. But maybe after 2 years, after 1 year, after 3 years, the asset is now showing a favorable impairment conditions, like the market value of the asset has increased, the the changes in technological, the environment and the economic as well, it has not adversely but it favorably affected the entity, and then the interest rate has reduced. If there is any of such external indication, or internal means that the asset has not been damaged, the useful life has not reduced, the economic performance has not worsened off, then there is an issue of reversing the impairment that we have already accounted for. You have to reverse it. But this is the case. You cannot reverse an impairment loss in excess of the carried amount of the asset if that impairment has not occurred. It means that, assume that on the day of the reverse, the carried amount of the asset was supposed to be 18,000, but the reverse is more than this amount. If you want to reverse the asset, it will be more than this amount. It is not allowed. You only reverse the asset to its carried amount as if the asset was not previously impaired. And then any reverse amount is treated as a gain straight away in the P or L account. Remember again that if the asset was previously recognized in the OCI and you have probably sent your impairment loss to the OCI, then the gain, which is the income now, has to also go to the OCI before the SS goes to the P or L account as a gain. That's the treatment over here. So remember that anytime there's a reverse of an impairment loss, it must first you are supposed to first determine the impairment loss that has been reversed and probably becomes what the income of the asset or the income to the entity, and then the year in which that reverse has occurred, you just take that amount to the POL as an income, or if the asset was previously recognized under OCI, you take it there as what, as income. Now let's take some questions to see how we can establish our understanding about the reverse of an impairment loss. So we're told that RONAS purchased a current asset. So here, RONAS purchased a current asset on 2011. So that is the day we purchased the asset. That is the purchase price, and then the amount the asset was purchased was $30,000. $30,000. Now you are told that at that date the asset had a useful life of 10 years, and then we were told RONAS does not revalue this type of asset, so the asset is not revalued, but account for it on the base of depreciated historical cost. So here, and then we were told that at 31st December, so the asset was bought on 1st January 2011. So here we are saying at 31st of December 2012, the asset was subject to an impairment review, and as at this date, the recoverable amount of the asset was $16,000. $16,000. All right. Now we were also again told that at 31st December 2015. So at 31st December 2015, the asset shows that some favorable circumstances, and then the impairment to recognize has a reverse and are no longer applicable, with the result that the recoverable amount, so as at this day, the recoverable amount is now $40,000. Now the question is explain with supporting computations the impairment on the financial statement, and then the statement of the two impairment reviews. So this is the question we have. Remember the question link we provided in the video description so that you can get access to the full question. Now this is the question we have. The issue is, how do we account for this with the appropriate computation? So now let's look at before the asset was impaired. Before the asset was impaired, we have to determine the carried amount of the asset as at the date that it was impaired. The annual depreciation before the asset was impaired is going to be the 30,000 all divided by 10, which is going to give us 3,000. Now what is the carried amount of the asset as at 2012 December? All this is December, so as at 2012, because the asset was impaired in 2012. So what is the carried amount? It's going to be the 30,000 minus accumulated depreciation of how many years did we use the asset before this time? We used it from January to December 2011, and from January to December 2012. So 2 years. So 2 multiplied by the 3,000 gives us 6,000. So we can bring it here. 2 multiplied by 3,000 gives us 6,000. Minus this will give us $24,000. $24,000. Now, what is the recoverable amount of the asset? We were told that the recoverable amount of the asset was, as at that date, $16,000. So there is an impairment. there is an impairment loss over here. Impairment loss of, that will be 8,000. There's an impairment loss of 8,000 over here. So immediately we reduce the asset to its carried amount. So its recoverable amount of 16,000, and then send this amount, which is an impairment loss, to the POL account because we were told that the asset was not previously revalued. So this is the first treatment, and this is how to establish our carried amount. The recoverable amount was given to us, so there was no header over there. Now the question is, as at 31st December 2024, the asset is now showing some improvement. So now let's determine the carried amount again as at 2015. Now the annual depreciation after the impairment in 2012, we have to look for the annual depreciation after impairment. Now the asset carrying amount is now 16,000 divided by 8, that is 10 minus 2, because we have already used the asset for 2 years before the impairment PV was carried out, or the impairment was carried out. So we are now left with 8 years. So 16 divided by 8, and this is going to give us a dollar of 2,000. Now, what will be the carried amount as at 2015 December? Now we know that the new cost is going to be the 16,000 minus 3 times 2,000, because from January December 2013 is 1, January December 2014 is 1, and January December 2015 is also another year, making it 3 years. That's why we are seeing 3 over here. So you less this 6,000, we are going to get $6,000. If we less it from the 16, we are going to get $10,000. $10,000. Now this is the carried amount of the asset. That's at 2015. Now let's look at the recoverable amount after that date is 40,000. It's 40,000. So if that's the case, then there is no issue of impairment because the recoverable amount is higher than the carried amount of the asset. Then there is a need for, because previously we have already accounted for impairment loss on the asset, we have to reverse an impairment loss on the asset, or we have to reverse it. Now, how do we do that? How do we get the value to be reversed? This is how it goes. Let's assume that the asset was not impaired. That means the asset carried amount, the asset annual depreciation is going to be the 3,000. So what will be the carried amount if the asset was not impaired as at 2015 December? So if the asset was not impaired, it's going to be from January 2011 is 1 year, 2012 is 2 years, 13, 3, 14, 4, and then 15 is 5 years. So 5 years. So the cost of the asset is going to be the original cost, which is a 30,000 minus 3,000 times 3, because it's times 3 because the original annual depreciation before the impairment was 3,000. So the accumulated depreciation will be 3 times the 3,000. So if you less this from this is going to be the $15,000. You less it from this, you are going to get $15,000. $15,000. Now, what is the current carried amount of the asset? The current carrying amount of the asset is $10,000. Now, the difference between these two is giving us $5,000. So this is the gain, or this is the impairment reverse we are going to carry on the asset. Immediately, this amount must be credited in the POL account as a gain, or it must be sent to the POL account as a gain, and then the asset now will be carried at this carried amount, the $15,000. So this is basically how to go about reversal of an impairment loss. Remember that you first have to account for the impairment. You see here the impairment was 8,000, but we cannot recover it up to the 8,000 because of what we take into consideration as if the asset was not impaired to establish its carried amount, and then you also establish the carried amount as if the asset was impaired. The difference gives us the gain to, or the amount of impairment loss to be reversed or to be treated as what, as a gain. So please don't forget, and how you know how to treat this. So probably this will be the statement of financial position item. And then remember that the yearly depreciation also goes to the P&L account as an expense. So this is how to deal with the reversal of an impairment loss. As indicated earlier on, there are sometimes the entity will have a group of assets that do not generate cash inflows independently on its own. They generate cash inflows together, or they are the smallest identifiable group, which if they generate cash inflows, that cannot be identified, or that cannot be independent of the inflows from other assets or other group of assets. And this group of assets, we call them cash generating units. So cash generating unit, also known as CGUs. Now, when there is an impairment of a cash generating unit or group of assets, then there's a way we should account, or there's a way we should go for such impairment computations. So remember that if there's a CGU, or that means that these assets do not generate inflows independent of on their own. So in this case, what you do is that you determine the carried amount of the CGUs. So you determine the carried amount together for the CGUs, and then you also determine their recoverable amount of the cash generating unit. So if there is any impairment, this is how you should go about it. With these CGUs, may have more than one asset, but collectively you look for their carried amount and then collectively look for their recoverable amount. Then if there is any impairment, this is how you attribute or allocate the impairment to the individual assets that constitute the CGUs. The standard prescribe how you should allocate the impairment. So assuming that there is an impairment of $50, that is an impairment loss. This is how you should go about it. If there is a specifically impaired asset, then we should take care of that asset first. There are some assets that will be in the CGU that are worthless, or that are specifically, the question will tell you that this asset is specifically impaired with so and so amount. Then we take care of that first. Then the next is that we take care of goodwill. In fact, the goodwill, all the impairment of the goodwill should go. So assuming here there's a worthless asset of $5, we take care of it. Then goodwill is $20. Then all the 20 will go. The goodwill, you take care of all of that, and then it will be left with $25 over here. The $25 will be allocated to the asset on a pro rata basis. What do we mean by that? If you have machine, which is, let's say, 10, that is a carried amount. Let's say you have plant, which is 5. Then on pro rata basis, we said the 10 divided by 15, the summation of these two multiplied by the 25 gives us the one that goes to the machine. So this is about the pro rata basis, and this one will be 5 divided by 15 multiplied by the 25 gives us the impairment for the plant. Remember that a reversal of an impairment does not go to goodwill. The assumption is that anytime there's a reversal and then the goodwill is there, we don't reverse goodwill. Why? Because we know that this goodwill that has been impaired is a purchased goodwill. Then any goodwill that will arise again may be internally generated goodwill, and the standard does not recognize internally generated goodwill. So remember that this is how you should account for a CGUs anytime there's a question like that pertaining to them. So without wasting time, let's look at the question, and then we use that to augment or establish our understanding. Remember again that this question will be in the video description, so that you can get access to the question and then you can follow the solutions judiciously. Now, in this particular example, we were told that RONAS runs a unit that suffers a massive drop in income due to the failure of e-technology on 1st January 2018. The following carried amounts were recorded in the books immediately prior to the impairment. So we were told that the following carried amount was recorded. So we have goodwill there, which was $20. We have technology, which was $5, so 5 over here. We have brands. The brands was $10. We also have land, and then the land was $50. And then we have building. Then the building was $30. And then we have other assets. And this other asset was 50. So let's sum them up. This gives a 70, this gives 120. So yes, this plus this gives a 70, 120, 130, 155. So $155. That is the total. Now we are also told that the recoverable value of the unit is estimated at 85 million. So the recoverable amount, remember that this is the carried amount of the whole cash generating unit, which is the 155. Now the recoverable amount here is $85. Then there is an impairment over here. The impairment over here is about the difference between this and this. So the impairment over here is going to be about $70. Now, how do we apportion this $70? Let's look at the question to the end. It said the technology is worthless following its complete failure. The other asset, so the other asset here, which is the 40, this asset comprises of inventory and receivables, and it is considered that the carried amount of these assets are net recoverable amount. So these assets should not be impaired, because remember that inventories does not fall within the scope of IAS 36B. The reason is that they are already carried at the lower of its recoverable amount, the lower of cost or net realizable value. So they are already hold for impairment review. So we shouldn't hold this particular asset for impairment review. Now this carried amount must suffer some impairment. How do you go about that? Now this is it. Like I said earlier on, any specifically impaired asset must be catered for first. So in this case, this asset must go. So the impairment. So impairment allocation, so that we can look at their new carried amount over after the impairment. So their new carried amount. So immediately this one must go first. It's quite unfortunate. So this will be 5 over here, and then the carried amount will be what? Will be 0. That is for the specifically impaired asset, because we're told in the question that technology is worthless as a result of a significant done failure. Now the next in the line should be what? Our goodwill. So here we have taken 5, we will be left with 65 what? 65 amount. The amount will be now 65. Now impairment is $20, and this automatically must also go. The impairment must also go for this one, which is what? $20. It's also off. How to remember. Now the rest of the assets must be allocated on a pro rata basis. Now we are left with 45, because 20 minus 65 will give us 45 impairment. So now we are left with an impairment of 45. Remember that these assets are not impaired, so here their carried amount will still be what? Will still be the $40. When we are left with the 10, the 50, and then the 30. Now if you sum these three up, we are going to get what? An amount of 80. So how do we allocate? It's going to be the 10 divided by 80 multiplied by $45, because the remaining impairment loss is 45, so that we get it for the brands. Then we come for 50 divided by 80 multiplied by the 45. This goes for the land, and then the last one will be 30 divided by the 80 multiplied by 45, and this goes for the building. Remember that when you are impairing an asset under cash generating unit, the impairment should not, or after the recoverable amount or the impairment should not exceed its carried amount of the asset if the asset was what? Impaired individually. So you have to take note of that. the asset, the value should not be lower than its carried amount if it was impaired what individually. All right, so I think 10 plus this will give us 90 rather, not 80. So this will also be 90. This will be 90. So what you get here will be 5. So we take 5 from here, you get the carried amount now to be what? To be $5. And if you do this correctly, you are going to get 25 over here as well. So here the asset will now be left 25. So 25, and if you do this well, you are going to get 15. And then here the asset will also be left what? 15. So this will now be the carried amount of the asset after the impairment. So this is how to allocate impairment to cash generating units. Remember that you first take care of any worthless or any specifically impaired asset, and then you go on to look at the goodwill if there is any goodwill. And remember that if we have inventories or any assets that we have been informed that they are already impaired or they are already carried out, they are values that are not supposed to be held for impairment, then you have to ignore those assets. So this is basically about impairment. The necessary thing is about the disclosure. The disclosure is very important to the note to the financial statement, and here you can disclose about when the impairment occurred, the indications of the impairment, what the carried amount was before it was impaired, whether the asset was impaired using its value in use or it was impaired using its fair value less cost to sell. All those information must be present in your disclosure note to an impairment asset. So you have to disclose even the useful life of the asset before the impairment and after the impairment, what amount of useful life do you still have there. So remember that the question that we've looked at will have the link in the video description. If you have any question, feel free to leave it at the comment section, and thanks for always being part of the learning family. Thank you.